What ticks a ticker up or down? Before you buy a stock, ask one simple question. What actually ticks this ticker up or down? This lesson is for education only. It is not financial advice. A stock does not move higher just because a company is good, and it does not fall just because a company is bad. Most of the time, a stock moves when expectations change. If the market expected good news and the company only delivers good, the stock may not move much. But if the company beats expectations, raises guidance, expands margins, or strengthens the story, the ticker can move up quickly. Here is the simple StockIQ formula. Ticker movement equals earnings power times valuation multiple times market mood. Let's break that down. Earnings power is the business engine. Is revenue growing? Are earnings improving? Are margins expanding? Is free cash flow getting stronger? When earnings power improves more than expected, that can tick a stock up. But when earnings disappoint, margins compress, or guidance weakens, that can tick a stock down. The second piece is valuation. Valuation is what investors are willing to pay for that business engine. The same company can trade at a higher or lower multiple depending on growth, interest rates, risk, and investor confidence. If earnings rise and the market is willing to pay a higher multiple, the stock can move sharply higher. But if earnings rise and the multiple falls, the stock can stall or even drop. That is why good earnings do not always mean a green stock. The third force is market mood. Sometimes the whole market is risk on. Investors are willing to chase growth, AI, software, semiconductors, and anything with strong momentum. Sometimes the whole market is risk off. Investors prefer safer stocks like grocery stores, utilities, and anything with stable cash flows. These external factors can set your stock up or down, even when nothing changes with the company. That's part one. Continue to the next lesson to understand how to read price action and determine when to add to your position.
Other times, the market becomes defensive. Rates rise, fear increases, or money rotates out of a sector. When that happens, even strong companies can get pulled down. So, what ticks a ticker up? Earnings beats, raised guidance, margin expansion, a stronger narrative, sector tailwinds, analyst upgrades, new product cycles, and buyers willing to pay a higher multiple. Now, what ticks a ticker down? Missed earnings, lower guidance, slowing growth, margin pressure, a broken story, bad news, macro pressure, sector rotation, or a valuation that became too expensive. Let's make this practical. NVIDIA moved higher because earnings exploded, AI demand strengthened, margins expanded, and the market kept believing in the AI story. That is earnings power plus narrative plus market mood, all working together. Microsoft is different. Microsoft is more of a durable compounder. Recurring revenue, cloud growth, strong margins, and AI optionality help support long-term expectations. A compounder can move through volatility if the thesis stays intact. DRAM is different again. Memory and semiconductor cycles can move sharply with pricing cycles. When the cycle turns up, a DRAM-related ticker can rise quickly. But when the cycle weakens, it can also reverse quickly. That is why cyclical positions need exit discipline before entry. So before buying any ticker, ask two questions. What could tick this up? And what could tick this down? If you can only answer the upside question, you may just be buying a story. But if you can answer both, you are starting to think like an investor. The goal of StockIQ is not to predict every move perfectly. The goal is to separate the forces: business results, valuation, narrative, macro, news, and risk.
Know the engine. Know the downside trigger. Know what would prove you wrong. Then decide whether the ticker belongs in your portfolio.